ocean will be down warm. Upstream, are you with me? Feel it. Down warm. Upstream, are you with me?
Ladies and gentlemen, it's Adrian Zintrix, CMT Charter Market Technician, CryptoBurp, and welcome to another show of our sixth edition of the Free Trading Congress virtual conference, virtual trade camp for traders designed to help you become better at trading, to stop sucking, stop missing out all of those rallies, catch all those incredible pumps that are actually ahead. See how you actually can detect, those early gems at different early stage of adoption of growth, and how to basically not to get and lead to the financial ruin. And I'm here joined, on several sessions throughout the day by the best speakers, by the best professional traders, that are seasoned portfolio managers, by the hedge funds, by the VCs, by the market makers, by people who actually contribute to the space, who create this space. And today's session is going to be joined by my true, genuine friend and brother, almost in blood, in blood. I'd say one of the best Polish American persons that I know that could speak about profitability, that could speak about finding highly probably and probabilistic and highly profitable setups in crypto, outside of crypto, and traditional space, and the completely degenerate space, using many different techniques and charting skills. A friend who started off also on the CMT path, even though there's so much more experience that he's got behind the scenes to the game itself. And I also know Jake, for being one of the largest Twitter creators on Earth right now, right under Elon Musk somewhere over there. Ladies and gentlemen, without further ado, Jake Wujastyk himself, the man, the legend, my favorite guy. How is it going, Jake? How are you feeling?
Good. Thank you for having me. I was going to say happy early Thanksgiving, but I guess that's not a Polish thing. But either way, happy Thanksgiving to everybody who's celebrating. Kind of a short week in the markets, at least on the equity side. As you kind of introduced me, my name is Jake Wujastyk, and I really focus on technical analysis to find triggers and validations, high probability setups. And, so today I'm going to go over, I think we have about 30 minutes, go over kind of how I find these setups and do a little Bob Ross action. Going to take an Nvidia chart and kind of show you guys how I would create that chart and kind of go from there. But I'll also touch on, upper indicators, lower indicators. These are all types of things that I use in my analysis. So I'm excited to go over everything.
By all means, and without too many words for myself, because I always, when I speak too much, people go to sleep. We don't want anybody to go to sleep right now, because we want everybody glued their eyes basically to this incredible presentation they're gonna have throughout. You're gonna lead us basically, as well as give us a little bit of the expertise and show it actually how technical analysis works and how we contribute to the market education. Actions over words. If we are ready, we are ready. We can give it a cut straight to the chase.
All right, let's do it. So as I just kind of mentioned, some of the things I'm going to be outlining, I'm going to define everything first, and then we'll get into the visuals. So the first few slides are going to be a lot of text and just kind of outlining things. So if you guys want to take screenshots, whatever, if you want to use this, for further learning. But the thing that I really use in the market to find high probability setups is a set of lower indicators. And that is essentially anything below the price chart. And then on top of that, if you can find a setup that has both the lower indicator setup and the upper indicator setup, which an upper indicator is simply just anything that interacts with the price on the actual price chart, then that is like a very, very solid setup when you have both of these things working together. Now, it doesn't always happen like that, but if you can find a setup that has both the lower and the upper indicators showing something similar or showing the ideal optimized setups that you're looking for, we'll go over kind of a case study on that. So I'm going to go over the lower indicators, upper indicators, and then kind of put it all together and then go over an Nvidia chart and show you how I would kind of look at this pretty much from scratch. And then we'll go over some recent case studies touching on, looking at the lower indicator side, looking at the upper indicator side, and even sometimes putting multiple time frames together. And then I'll touch on a couple setups showing high probability setups right now in the market. So a lower indicator is, as I mentioned, anything that is below the chart. So that can be an oscillator, that can be anything that's oscillator is essentially anything that's moving between two thresholds. So for example, you've got the RSI. One of the things that I use is the Williams percent range. The MACD is a type of oscillator. It's not exactly as extreme as far as you only have 0 to 100 or 0 to negative 100 as your y-axis, but it is a type of oscillator. But there's a ton of different types of lower indicators. You've got on balance volume. So it's what I'm going to be focusing on is the oscillator side of things and how you can use those to find these setups. One of the things that I'll mention about lower indicators is they really need to be optimized for different markets, different assets, different time frames. So, so that is, I think, something that a lot of people maybe miss out on as far as the understanding of how lower indicators work. A lot of people just use a default. And so, you really do have to use backtesting software, whatever that may be for you, because you could find a very high probability, highly predictable, statistically significant setup on maybe Apple, and then it means absolutely nothing on Tesla because they're really two different personalities. And so this is, that would be on the equity side. It's no different than if you're looking at Bitcoin versus Solana or Ethereum. Each asset has its own personality and how it responds to these lower indicators. So really when you're optimizing the oscillators, you want to look at lengths, you want to look at look back periods. So essentially if you go to the RSI, it's going to default you to the 14 period look back. Now, the period is simply just whatever time frame you're on. So if you're on the weekly candle and you have a 14 period look back, you're looking back and taking data over the last 14 weeks. If you're looking at a 5-minute chart, you're looking at the last 14 5-minute candles, and that's what the RSI is essentially spitting out data from those candles. And so one of the other ways that you can really optimize this is what you're trading. So for example, if you're trading crypto versus equities and crypto have different open markets. So you sometimes even have to optimize it there. So when you are looking at these things, it's no different than if you're looking at an hourly chart on US equities, right? Technically, there's 390 minutes in a trading day. So if you're using a 1-hour chart, you're getting an uneven number of candles. You're getting 6.5 candles. So one of those candles doesn't even represent a full hour. So being able to optimize that to a 65-minute candle gives you 6 even candles. So shout out to Brian Shannon for teaching me that little trick. And I've used that in the optimization of oscillators and lower indicators as well. So what I mean by that is really looking at the lengths of time or the look backs, as I just mentioned. So if you're looking at a daily candle chart on crypto, there's 7 trading days in a week. So you can use increments of 7 because each 7-period look back is another week. So 7, if you're doing a RSI of 7 on the daily chart, you're looking back essentially 1 week. If you're doing a 14 period, you're looking back 2 weeks. If you're looking at a 21 period, you're looking back 3 weeks, so on and so forth. Now that works for crypto. But if you're looking at the daily candle on US equities, there's only 5 trading days in a week. So what I like to do is I like to use the 5 period on the RSI or the Williams percent range or anything else that has a look back period like that. You really want to optimize it to whatever asset class you're trading in, and also whatever market as well, or time frame. So for example, if you're looking at crypto, the 6-hour chart makes sense because there's 24 hours in a day. You divide that by 6 and you have 4 even candles. But using a 6-hour chart on the daily candle for US equities doesn't make a ton of sense. So, those or equities in general, sorry, not the daily candle, but the 6-hour candle on US equities doesn't make a ton of sense. So really that's what I mean by optimizing, where you're essentially making sure something's divisible by whatever you're looking at, whether that's crypto, trading 7 days a week, 24 hours a day, or looking at something like US equities that are trading 390 minutes a day, 5 days a week. 2 different time frames, 2 different open market hours. So that will change how you optimize these oscillators. So that's kind of the lower side of things. Now on the upper indicator side of things, and I'll go over the 3 indicators that I use once I'm done mentioning the upper indicators here. So as I mentioned, upper indicators, anything that interacts with the actual price. So that can be the anchor VWAP, it can be the volume profile, it can be a moving average, it can be an Ichimoku cloud, pretty much anything that's on the actual price chart and not its separate kind of tab under the price chart. That's technically an upper indicator. It's on the upper part of the chart that price interacts with. And there's a ton more. I just kind of mentioned the main kind of main common ones that everybody knows. Now, for me personally, I will look at a moving average to see more or less is something trending up or down in the short term or long term, the 20, the 50, the 200. But a lot of the time, if you stare at charts long enough, you can generally get an idea if it's in an uptrend or a downtrend without having to turn on the moving averages. But for the most part, I'm using the anchored volume profile and the anchored VWAP zones for the most part, which are created by using percent offsets. So the anchor portion is probably something people aren't familiar with. I'm sure they've heard of VWAP before, VWAP traders or intraday traders that are using more of a continuous VWAP. The anchored VWAP or anchored volume profile is when you're actually anchoring from a specific point in time. So this is another shout out to Brian Shannon. He's really the godfather of the anchored VWAP, the anchored volume profile, all of that. Or excuse me, I kind of use the anchored volume profile in the same type of way he used the anchored VWAP. And so either one of them is anchoring, where you're starting from a either pivot point. Brian Shannon likes to start from the year to date, so he likes to use the year to date VWAP. So you're essentially starting at the start of the year and measuring what is the dollar cost average of every single share that's been traded since the year to date. And that essentially gives you the ability to see what is, where does the average person break even since a specific point in time. So this helps you in seeing potential support, resistance levels, or even triggers, right? So if you have a thesis, you generally need a trigger. That trigger is generally X close above, whether it's a horizontal level, whether it's a VWAP, whether it's a moving average. Everyone's going to have their own kind of triggers. So the VWAP helps validate or invalidate setups with these triggers. And I'll get into that more.
I couldn't agree more, by the way, about Brian Shannon, CMT. Everybody, make sure you follow not only Jake Wujastyk or Jake Wujastyk by the American pronunciation. Also give a hit follow button for Brian Shannon, who's a person behind the VWAPs, the anchor VWAPs. Incredible stuff from him always, and from you, Jake, as well. Sorry to cut in, just couldn't resist. Incredible legacy,
no.
beautiful names, just really right there. So yeah, I'm listening. Very, very interesting so far. I'm 100% into it myself, as in the presentation. So we can go along. Yeah.
So can you see my Nvidia chart?
Yep.
Okay. So I'm going to kind of start from scratch on how I look at the markets, right? So there's a few different ways that I look at the markets, and a main way is using the anchored VWAP. And really the way to use the anchored VWAP is finding essentially a point in time. Generally, these are pivot points, important capitulation points, i.e. starts of trends on the downside or the upside. So pretty much when the status quo changes, if you will, in the market. Now, for the anchored VWAP on TradingView, you essentially just I already have a list of indicators and things that I use. And by the way, I say upper indicator, but a VWAP is not really an indicator, right? It's not indicating anything. It's literally telling you what the price is from a specific point in time and what is the average volume price from X point in time. So like the RSI can indicate overbought, oversold, whereas the VWAP or the volume profile is just telling you straight up, okay, this is the volume weighted average price. This is the point of control. This is where a lot of shares are holding from a specific point in time. And I'll go over all that here in a second. So the first thing when you're using the anchored VWAP, what I do at least is I kind of start from each pivot. So for example, here, the pivot from October 31st, if I anchor the VWAP here, it's not really statistically significant, right? Price hasn't respected it that well. So to me, it's not a VWAP that I'm interested in. Now here's a slightly lower low here. If you anchor the VWAP here, same thing. Price is really not respecting this VWAP. You can see that it's trading around it, which is fine. But if you have price trading too low or too far above the VWAP, it's not as significant or relevant. So then what do? I pull it back here once again. I pull it back to this point. Now this point definitely is something that I'm interested in. One, because price has respected this anchored VWAP multiple times, right? You can see on October 15th, you bounced. On October 31st, you slightly closed below it, and then you bounced right at it and opened at it on November 1st of 2024. You bounced at it perfectly here on November 18th. And then yesterday we closed slightly below it, and now we are kind of trading below it here for the second day in a row. Now, this is where the percent offsets come in, right? So I know that price has respected the VWAP X percent below this point. So what I want to do, so I don't have a false signal like we had here on October 31st where price actually closed below it. We know that price has technically closed below this VWAP and still held up and continued to hit higher highs afterwards. So I want to create essentially a VWAP offset around the bottom of this candle so I don't have another false signal. So then you can use this as a way to validate or invalidate a bull thesis or a bear thesis, right? So that's what's nice about these VWAPs is you can essentially use these on both bull case, bear case, and I'll show you kind of what I mean by that here in a second. So in this case, and a lot of the time, I can kind of eyeball it, but sometimes, it takes a couple of tries. And what I want to do, I just want to find what percent is right at the bottom of this area. So I go here, I pretty much just click on the anchored VWAP, I go to style, and I click on lower band, and I have to make sure that my band's multiplier is turned on. I essentially have a 1% lower band offset. So that means essentially a secondary VWAP, the same exact one from this pivot point on October 2nd, but then I'm trying to capture this here. So you can see the 1% offset doesn't necessarily capture the bottom of that wick. So then you go in, put 1.25. Still not there. 1.5 is probably right where you want to be. Okay, so now you're pretty much capturing this candle. And then you're also capturing this candle right here, which price technically slightly closed below on, what was that, Monday, yesterday. So, as I mentioned, it's not necessarily what I'd call a perfect science. This is kind of an example where if you were using a potential bull bear thesis trigger and you really wanted to get exact here, a daily close below this lower band would technically trigger the breakdown here. Now, you can see here, there still is a very little bit of a wick here. So if you really wanted to get that exact bottom of that wick, just do another 0.25% increment. So now you can see literally, this is pretty crazy. The VWAP band, this 1.75% lower VWAP, is literally exactly where price closed yesterday. And so because you did not close below the bottom of this band, the bull thesis is technically not invalidated. Now, this is where you can kind of start creating targets or triggers or anything like that. Now, if the daily candle close does close below that today, then that would definitely be the bear thesis short-term trigger here. So what I would do is I'd say, okay, here's a previous resistance zone. And generally what I do is I kind of take this entire zone here. So I'm taking the wick from this candle here on August 19th, and then I'm connecting it to this body here, and then I'm essentially just extending it over. So this previous resistance zone has already flipped to support once. So if we were to close below the bottom of this VWAP zone, then this zone below would be your downside target. So this is where triggers are really important. Now, depends on what you're trading. If you're using a daily candle close as your trigger, then you would really need to wait until the end of the day to see, okay, are we going to close below this band, which is currently right around 135.90. So if there was a daily close below 135.90, that technically would trigger the short-term downside target of this previous resistance zone, which is flipped to support. In the CMT, they call these SR flip zones. So previous resistance or previous support flips to the opposite, whether that's resistance flipping to support or support flipping to resistance. So SR flip kind of makes it sound like it's just support flipping to resistance, but it goes either way. Now we have the anchored VWAP here, and we have this setup, right? Now we can cross-reference this with the lower indicators. So if we switch over really quick to my slide again, high probability setups. You can see here that, as I mentioned, I use the RSI, the Williams percent range, and the MACD for these lower indicators. Now, what's interesting is you can see here that there's not a ton of indicators I'm using. Why? Because if you use too many indicators, you essentially are getting analysis paralysis. If you're using 7 different indicators to find a signal, every single indicator is technically going to tell you that you're right or wrong. If you're using a smaller set of indicators, then it's a lot easier to kind of get a better signal and not as much noise, right? So I kind of have been using this combination of lower indicators, the RSI, Williams percent range, and the MACD for quite a long time. And I've kind of refined it over the years. And so, the RSI is essentially an oscillator. It oscillates from 0 to 100. Pretty much the thresholds there. Over 70 is technically overbought. Below 30 is oversold. The Williams percent range is actually kind of like an ultra sensitive RSI. So generally the Williams percent range is always going to get oversold first. And then if you do have, and I say oversold because technically it's below the bottom of that threshold, which considers it oversold. But a lot of the time, what will happen is the Williams percent range will actually become oversold. And if the RSI is not also oversold at the same time, you generally have more downside to go. And then the MACD, I think a lot of people are familiar with the MACD. It's essentially a way to gauge reversals in the market and really just using a 2 lines, the MACD line, the signal line, and those kind of are tracking. If we're kind of getting close to a bottom, you've got the MACD curling up. If you've got potentially a top, that's the MACD curling down. So I'll switch back over to the Nvidia here and show you kind of how this all works. So one, and by the way, if anyone ever follows my charts and they're always wondering what, here it will say 10-2 pivot. That just means this is the pivot. I'm defining what the pivot point is and what date it's from. So anytime you see that on my chart, that's simply just telling you when either the anchored VWAP or the anchored volume profile is originating or starting. So on Nvidia, you can see here that we pretty much have these 3 indicators, the MACD on top. You can see here that we have the Williams percent range in yellow, and then we have the RSI in blue. Now, you can see here that the MACD it's not showing us much of a signal at all. It's kind of essentially noisy at this point. So I'm just going to hide that and focus on the RSI and the Williams percent range. Now, notice here how the Williams percent range is oversold. Well, as I just mentioned, technically, when the Williams percent range becomes oversold, you have more downside on the RSI. Well, the problem with using this particular RSI, this is the 10 period this is the 15. Generally, I'm using the 10 period RSI on a daily candle chart. So that means I'm essentially looking back 2 weeks. So as I mentioned before, a 5 period RSI is looking back 1 week, 10 period RSI is looking back 2 weeks, 15 is 3 weeks, et cetera, et cetera. So the problem though is notice here that there were points on the chart like here and around here that these were important bottoms, and even here, but you can see here that the RSI did not signal it, and neither did even the percent range. So sometimes what you can do is you can optimize this even more. So if you go to the 5 period, let's say here, then all of a sudden you can see these points where there's oversold action on the Williams percent range happening. And then if you also optimize or lower the RSI to 5, pretty much a 1 week look back, you can now see that we're starting to possibly see some signals here. For example, here on October 31st, we had price testing that VWAP zone, and both the RSI and the Williams percent range were oversold. That was a pretty solid signal here. Now you can see here on October 2nd, you didn't necessarily get the exact oversold signal, but you did get it on the Williams percent range. Well, now we are right back here where the Williams percent range and the RSI are both oversold on the 5 period, and you are trading right at this VWAP. So, one thing to always look at is, is the risk to reward good here? Well, if you're simply using an invalidation point of the lower band here, the lower VWAP band, which is currently, as I mentioned, I think right around 135.90, this is kind of where you draw a line in the sand. If there's a daily close below this price, I'm out. And then for your upside target here, it would simply just be the previous highs here. And I like to use zones. Notice here, once again, I'm pretty much taking the zone. The bottom of the zone starts at the body here of the November 7th candle. And then I'm making the top of the zone the top of this wick after earnings on Nvidia. So now price is currently at 136.93. So 136.90, all right, let's just call it 137. That's what it's at. Minus 135.90 is $1.10. So you're essentially risking $1.10 for the upside target of, in this case, this is, let's call it 148.90 to 152.90. So now with the current price at 137, you're essentially risking $1.10 to make about $9 all the way up to around $16. So how do you know that's what you're willing to make? Well, you take 137, you take 148.90 minus 137. That's about it's about $12. And then you take 152.90, which is the higher part of this upside target, and multiply or subtract it by 137, and that's how you get your reward, right? Current price, the upside target minus the current price is your reward. The current price minus your invalidation is essentially your risk. So this actually presents a decent thesis here, right? One, you have the upper indicator showing that we've got support here. You also have these two lower indicators, at least on the shorter term time frame, signaling a potential reversal here as well. So that's really something that's really important. Now, I know we don't have a ton more time. I'm not sure exactly what time we started here, but I did want to kind of go over some different case studies here. So like what is currently showing an interesting setup here. But before I get into a current setup, I want to go over a pretty interesting multi-time frame example here on Walgreens. Walgreens boomer stock for sure, but the signal was there and it actually ended up working out very well. So here you can see here, this is kind of putting all together and using multiple different time frames, right? So in this case, we were looking at a 1 week chart on WBA. This was back in This was back in, I think, mid-October. You can see here that we had a very similar setup as we did previously, right? And notice these boxes all happen at slightly different periods. So generally what you're going to see is you're generally going to see divergence occur first on the RSI and the Williams percent range. And the divergence is essentially shown by lower weekly closes, but then you can see the RSI shown by this upward sloping pink line is showing pretty much that you have a higher low on the RSI, even though you have a lower close on the weekly price. And then same thing with the Williams percent range, lower lows, but you do have these higher lows on the Williams percent range. And then you can also see that the MACD is starting to curl up. Now, you're probably wondering, where's the histogram on here? I personally don't use the histogram. I think it just gets a little clunky. But if the histogram on the chart is essentially, if you see those bars on the chart and you're wondering, what do these bars mean? That's essentially the distance between the MACD and the yellow lines, the signal line. So as the MACD starts to get closer and closer, the blue line starts to get closer and closer to the signal line, the yellow line. You'll see if you have a chart open right now and you're looking at the MACD, that those bars are getting smaller and smaller because those bars are representing the distance. So as those bars getting smaller and smaller, you can see that the MACD is likely either about to cross to the downside or the upside. So here we've got the signal, we've got the MACD curling up, we've got the actual cross, we've got the RSI oversold, starting to move out of oversold territory with the divergence. And then you have the Williams percent range in oversold territory as well, moving out of oversold territory with the higher lows. So on the weekly time frame, you've got a very solid setup here. Well, then on the daily candle time frame, this is the daily candle around that same time on Walgreens WBA. You can see that we not only have an inverse head and shoulders here, which is a setup that I use all the time for potential reversals, but then you also have this volume shelf, right? So I didn't go over the volume profile much, but essentially the volume profile is a tool where you can see instead of volume as a function of price. So notice, most people have volume bars on the bottom of their chart. Well, that means that it's a function of time, right? You're measuring volume each candle, which means that you're measuring it each day, each week, whatever candle time frame you're on. Now, when you're using the volume profile, you're measuring how much volume has aggregated at a specific price. So in this case, you can see here pretty much from this reversal that we saw in May, since this point in time, where has volume occurred? And this isn't necessarily buying volume or selling volume. It's just volume, right? You have to have a buyer for a seller. You have to have a seller for a buyer. So I don't look at this as, is that buying volume? Is it selling volume? I look at it as this is where volume has occurred. This is where transactions have gone through. The further out the gray, these bars, the more volume that has occurred at that price. And you essentially can see each one of these bars has a width. So each width of that bar is measuring the range of price that you are measuring, right? So let's say this bar is from $11.50 up to $12. That means this bar, if you can see my mouse, this bar right here is essentially measuring how much price happened from $11.50 to $12. So it can create support zones, it can create resistance zones. And I know this isn't a long presentation. I have an entire 7-part video series going over, all of these things in a lot more detail. So if you're not catching exactly what I'm talking about, just go to my YouTube at Jake Wu Market Research, and literally I have all the videos explaining this in a lot more detail. But
or simply go ahead and subscribe to Jake's content creator subscription on X, which is something that I couldn't recommend enough. Like I said, one of the most successful persons in the world right now, right after Elon Musk himself, the creator. You cannot get much better than this. And at the same time, I can wholeheartedly agree with what Jake said. What an incredible guideline and kind of like a guidance through using those multiple timeframes analysis with the volume shelves. And that's something I used to use a lot myself. However, I don't incorporate it too much in terms of like the trading aspects. However, I fully agree that they often coincide with the reversal, so with critical kind of like pivots in the markets, right? They show significant resistance, show you the biggest flashouts in the market. So typically, the biggest flashouts is exactly the reversal points, right? So funnily enough, this is something that that works very well. And having just a couple of more minutes, like 5-10 minutes maybe max,
Okay.
for everybody to take away from the presentation, from the notes. What is it, Jake, that you would love for everybody as well to kind of like familiarize before we wrap the session in just in a couple of moments? Yep.
Well, I mean, definitely, don't overcomplicate things, right? I'm using 3 lower indicators. I'm using literally the VWAP and the volume profile, and that's about it. You sometimes see like a ton of trend lines or all different things on a chart. Moving averages are great. They help you identify trend, but I've found, at least in my experience, that VWAPs are a lot more powerful, acting as actual resistance or support. Moving averages are great, especially if they become self-fulfilling, meaning, if everybody's looking at the 200-day moving average, sometimes the 200-day moving average will act as support or resistance because everybody is using it as a point on their chart as potential resistance or support. And it kind of becomes just, as I mentioned, self-fulfilling. But on top of that, you definitely want to use volume as well. Now, as I mentioned, I'm not using really volume as a function of time. It doesn't do anything for me. I'm using volume as a function of price. That's essentially what the anchored volume profile is. And really finding what I like to kind of call air pockets in price, right? So essentially what I call a volume gap. And these volume gaps are this area, this orange area here. And generally what happens is you don't have a lot of volume in these gap areas, right? So prices can move very quickly because let's say that you entered Walgreens at $11 a share. And at this point, the price was at $9 a share. Well, you're down, a decent amount. So what happens is these areas, if price is below one of these kind of aggregation areas where you have a lot of volume, these areas act as resistance because they essentially are supply zones, right? Let's say that you have WBA at $11, price is at $9. As soon as the price goes up to $11, what are you probably going to do? Probably take a little bit off the table because you're like, wow, I just dealt with a drawdown. I'm back to break even. I'm going to get out either fully or partially. Enough people do that at the same time. It creates essentially levels of resistance. Same thing with on the downside. If price is above a shelf or a volume node, that means that, those people in this particular case, you can see where it says volume shelf. This is an area where a lot of people are pretty much now at break even. So they're unlikely to sell because they're back at break even. So the third part of this is what these volume gaps are places where you don't have a lot of people holding, which creates this area where prices can move very quickly because there's not a lot of friction. You don't have a lot of people break even selling. And so you can see here, we had the weekly setup. We had the daily setup with the volume shelf and the volume gap. And then you can see what happened. Price moved literally within 1 day through this entire volume gap simply because you didn't have a lot of friction. These volume gaps act as essentially vacuums or areas where price can move through very quick. If you're playing football and you run through the line and you kind of get you run through the defensive line and you get the ability to kind of start accelerating your speed because you got through the defenseman, you can move a lot quicker because there's no friction there. There's nobody trying to defend you until you get to the next defender. The next defender
How about explain it in the golf terms?
The golf terms. Oh my gosh, I don't even know how to explain it in golf terms.
You started off with football, so I couldn't resist, man. Not many people know that Jake is an incredible golfer himself.
No, I'm not. I'm not. But we did have a lot of fun in Dubai. That was quite the round of golf, I must say.
It was.
But yeah, those are the things that I really like to touch on here. Here's another example. You've got the MACD curl on Tesla's monthly chart. So you've got one of the lower indicators, and then you've got the volume shelf. This was at 260. Now Tesla's at 340 or something. So, you can really pair these upper tools. I'd say upper indicators because that's technically what they're called, but you can use these tools on the upper part of the chart and cross-reference them and use them together with these lower indicators. Now, I'm sure there's a lot of I'm sure there's more maybe Bitcoin or crypto traders in here than equities. So I do want to show a very quick case study on Bitcoin here and show you guys how you can use the volume profile on Bitcoin.
Perfect
Right.
way,
So a couple
perfect
of
way
days,
to wrap a show for everybody, actually. So pay close attention, everybody. Yeah, go ahead.
Yep. So a couple of days ago, you could tell that we were starting to kind of lose a little bit of momentum here. And honestly, the volume profile, the anchored volume profile and VWAPs sometimes work better on crypto because there's just so much more raw supply and demand on the crypto side and a little more of a free kind of trading atmosphere. So notice here what happened. I kind of had a downside target of $92,000 as of yesterday. Why? Well, because we simply had a volume gap here. There's not a lot of volume until we get down to around 92K. So we were able to move very quickly through this area because you didn't have a lot of volume, essentially creating that friction for price to move through. And same thing now, right? What happened? We moved right down, slightly undercut 92K. And now what did we do? We bounced at the volume shelf, and we could seriously go right back through this volume gap as quickly as we moved down, simply because you don't have a lot of friction. You don't have a lot of volume where people are breaking even to add supply on the market. So generally when I'm anchoring these VWAPs, I'm anchoring them from specific pivot points. In this case, this was the pivot pretty much from Monday before the election, November 4th. And you can see how well price is respecting this area, this volume shelf. And even if you go to the previous, and I'll wrap it up here, even if you go to the previous setup before that move happened, you can see this here, right? You've got Bitcoin. This was back in mid-November. You've got the volume shelf set up. Price is starting to get above that shelf. You have your upside target, which was a 4.618 extension of that measured move from October 29th to the 4th. What happens? You move right off that volume shelf right to that upside target. And that's really how you can use this together. So as I mentioned, I do have a subscription on Twitter. You can check that out. It's only $10 a month. I do a lot of educational stuff there, but I also do a lot of information. I'm providing technical levels, triggers and validations, ideas in general. And if you want to follow me on Twitter or X, Jake __ Wujastyk, WUJ. That's probably all you need to for the account to actually pop up in the search bar. X subscription is very simple. It's just on X. Once you subscribe, you go to the subs tab on your phone or on your computer, and you get all the exclusive content there. And then the YouTube account is where I have that free 7 video series. If somebody's going to sign up to my X subscription, I want them to be able to have some type of reference point and way to learn the language that I'm using in this analysis. And so that is under Jake Wu Market Research. And I post it all the time, as a homework post a lot of the time on the weekends. So that's it. Thank you so much for having me, Adrian. And, I really appreciate our friendship and you having me on. And I'm hoping to see you in Poland soon.
Oh my man, I couldn't recommend enough for everybody to go ahead and hit the follow button. Jake __ Wujastyk with the WUJ. Make sure you hit a follow button and make sure you hit a subscribe button as well. Highly recommended. Just like you noticed throughout the entirety of the session, Jake is a master at his craft, and it's like watching a Picasso paint, basically. How we come from the bare naked chart, to all those famous chart setups that you guys see from Jake. And incredible rally, incredible feast for many technical traders. Huge shout out again to Axel Kibar that we brought classical technical patterns, to Brian Shannon, CMT himself as well for the view upside, to all the CMT industry as well as one, and ultimately to Jake himself for sharing so much of the time and wisdom with us. Jake, thank you so much, my friend, for coming over to the show.
Hey, thank you everybody for checking it out. Hopefully it was valuable, and really appreciate you guys having me on as well.
Thank you so much, everybody. And to stay tuned actually with the shows, with the sessions throughout the entirety of the Trading Congress 2024, I highly encourage everybody to hit a subscribe button as well on our YouTube. Make sure you stay notified, hit the notification bells. You know the drills. We have to push throughout all those YouTube and broken X algorithms that are not really allowing us get out of the shadow bands. So all in all, I've been your host, Adrian Zlichik, CMT. And stay tuned, because the best time is now. The best time to engage, the best time to hold stake in crypto, the best time to get interested, to subscribe to the right people just like Jake. The best time is now. I've been your host. This is Pleasure. God bless you all. See you around, and bye-bye.
Beautiful.